Hello, and welcome to another episode of the Simplified podcast. Today, we want to discuss the role of pension providers and how they are adapting over time, in particular, how they are taking on more responsibility to verify and confirm that the actions of the consumer are valid and in their best interests. I'm joined by some of our Simplified Wealth consultants to discuss this topic. So please welcome Dean, Tasha, Nina, and Anthony to the Simplified podcast for the first time. So first of all, can I start with you, Anthony? One case that has attracted some attention over the last few months in particular has been the Carey case. Could you provide some more background on this and how you think it will impact on pension providers?
Yeah, sure. This was actually a really interesting case. So the SIPP provider was held accountable for the actions of an unregulated introducer and ultimately the redress payable. So the sort of TLDR of it is that clients were encouraged to transfer their pensions in order to acquire leases of store pods in Blackburn, so a high-risk non-standard investment. Over the course of 6 months, about 580 Carey clients invested in these store pods, averaging less than 50 grand, which contradicted Carey's key features documents, warning against a full SIPP with less than 50k on account of their fees and lack of investment flexibility. Carey eventually terminated their relationship with the introducer, having learned that they received a 12% commission from the company marketing the store pods and that clients were being offered cash back on their investment. So they were only encouraged. This was deemed advice from a non-regulated source, which breached general prohibition. And in arranging the transfer, Carey was also in breach and therefore deemed liable. So I think, given the outcome of the case, I think SIPP providers will need to be more conscious of the risks involved in accepting business from unregulated introducers is ultimately the buck could stop with them, and that contracts and disclaimers will not alone protect against the risk of a transaction being held unenforceable, and that other business protections will need to be considered. I think the case has also demonstrated that failure on the part of the SIPP provider to note consistent investments into one location from an unregulated introducer will not be looked upon favorably. You know, this should be a red flag and treated as such. I think following this case, SIPP providers should be looking to review their relationships with unregulated introducers and be aware that they are potentially on the hook for any bad practices.
Very interesting. Thanks, Anthony. And I guess one aspect of this is, although it really does focus on the unregulated advice aspect, there's a clear signal with this and some other regulation that the regulators are looking at the pension provider to make sure that they are kind of looking out for the consumer in the activities that they're doing, and they're not just leaving it up to the consumer. So I guess coming to you, Tasha, so looking ahead in terms of future regulations, is there anything coming up in the horizon that is of interest in this area?
Yeah, so the government have consulted on a proposal which we think they're likely to issue final guidance for soon. It was meant to be in the autumn, so hopefully should be over the coming month or so. But the sort of aim of that piece of change is to protect people from pension scams during the transfer process. But the main change is that would actually enable pension providers to say no to a transfer, whereas at the moment they can't do that because of customers' statutory right to transfer. So we think, whilst we don't know the details of everything at the moment, we know that the pension provider will ultimately look out for amber and red flags. Now, if they spot an amber flag, they can actually refer the customer to specific pension scams guidance. And only once the customer can evidence that they've done the guidance, they can then proceed with the transfer. But if the pension provider identifies a red flag, then the provider can actually turn around and decline the transfer altogether, because of course they want to protect the customer from a potential scam and their hard-earned money. I think that So this piece of change is really to encourage or to empower pension providers, which I think is really good. And I think it will encourage them to do enough checks so that they can put themselves in a defendable position if they did ever decline a transfer. But I think that it could see a lot of work because they could ask for the customer or the advisor to provide evidence to make sure that the transfer is genuine. So that could be quite frustrating for the customer and the advisor because it could increase the length of time to process a transfer.
Okay. And can I come to you, Dean, and get your reaction to that and how you think that those changes, if they do come through, are going to impact on pension schemes and customers?
Yeah, I definitely agree that it's likely to increase the time it takes to actually transfer a pension in some cases. I think really providers need to be upfront with customers from the outset, probably at pension quote stage, just in terms of the types of checks that may be required, timescales, importantly, why these are happening. And I think they probably need to state that they do have the right to prevent a transfer if they feel the risk is too high. I think that needs to be stated from the outset. I think the key area for me, I think providers will no doubt look at their processes, controls, and training for their staff. The key area for me is training. These people deal with transfers every day. The people that actually process in the operational area, I think there needs to be a bit more risk maturity and risk awareness training in those areas. So just to help their staff identify red flags, amber flags, I think that just needs to be really clear. I think that the warnings and the things in place at the moment can be seen as a bit of a tick box exercise. And sometimes I don't think the consumer is really seeing the benefit of the risk warnings or the checks that are in place. So I definitely think this is definitely a positive thing. I think in terms of controls, that further increase the length of time of transfers, there'll probably be an extra element of quality checking in possibly all transfers, effectively signing off that the appropriate checks have been done with the customer or financial advisor, and signing off that the money can be released from the seeding scheme to the receiving scheme. But ultimately, I do see this as a positive. Scams are getting more and more sophisticated, and ultimately, if this protects the customer from losing money, then I just see this as a positive. Even though there may be some delays and customers may be frustrated, I think it's all in the benefit of the consumer.
Brilliant, thank you. And Nina, I know you've been keeping quite a close eye on the developments in terms of the pension dashboard that's due to be implemented over the next few years. What do you think the impact of the dashboard and its introduction will be to some of these changes?
Well, first of all, just for a bit of context, if there's going to be a staged onboarding beginning from next year, and there's currently 7 providers signed up to take part in that, including Capita and Aviva, with the expectation that they'll start transitioning to BAU from 2024. But it's still going to take a few years after that to get all providers connected. So we won't sort of get that holistic view for some time yet. But it is compulsory. So eventually it will show all personal, stakeholder, occupational and state pensions. So all providers will be compelled to connect to the pensions dashboard. There's still a lot of work that needs to be done to confirm the requirements and for the providers to get ready to connect. But the initial dashboard will be provided by the Money and Pension Service. And then other dashboard providers within the private sector can then sign up to provide the dashboards as well, but that will be a regulated activity via the FCA. So I think it will result in the customers being more informed and hopefully more engaged, and they'll be able to take a bit more control and hopefully be more empowered to make decisions, and hopefully more focused on their end goals. But then it won't facilitate them taking any further action within the dashboard itself. So they're still then going to need to go out to their providers if they want to take action in respect of the information that the dashboard has provided to them. So for example, if they wanted to increase their contributions, or they want to switch investments or request a transfer value. So I think providers are going to need to be prepared that once they've connected up to the dashboard, they may start seeing increasing volumes of requests in these areas, or possibly also queries in respect of the information that the dashboard's provided to them. But also, to help with this, the Money and Pension Service are putting some effort into what will happen with the onward journey after they've received the information through the dashboard. So they're focusing on providing wraparound tools with that and signposting, so to try and help answer questions such as, what will I need in retirement and how much should I pay? And I suspect as well that private sector companies that decide to sign up to be a dashboard provider will also, from a commercial perspective, be looking to provide more integrated tools around their dashboards to then facilitate customers taking action from within the dashboard itself, so that it's a more sort of joined up experience for the customer. So the other real key benefit that it's going to give to the customers is allowing them to reconnect with lost pots. So there's some big statistics out there, such as there's about £19.4 billion worth of pension savings, which is about £13,000 per person in unclaimed pensions in the UK. So hopefully the dashboard will help people reconnect with pots that they didn't even realise that they had.
Okay. Sorry, excuse me. And in terms of, so taking it back to pension transfers, then I guess the dashboard could be an interesting development in the sense that, does it negate the need to further consolidate your pensions into one place if you have the dashboard and you have that single view? I guess a lot of the driving force behind pension consolidation has been that desire to have it all in one place, being able to manage it all in one place, and whether the dashboard will actually mean that the pension transfers decline in volume over time?
Yeah, it's an interesting question. I think many people thought that it would lead to an increase in pension transfers because people are getting that information, and it might encourage them to consolidate their pots. But as you say, if they can log into one place and see all of that information in one place, does it then remove that need for them to go that extra step in requesting a transfer? So I think you might be right in it is sort of extra effort then on the customer's part to go to their provider and request that transfer. So perhaps just having visibility of all of their pension pots in one place will be enough for them to sort of manage it, make it a little bit more manageable for them.
Okay. And in terms of the providers joining on to the dashboard, or one of the varieties of dashboards that may be coming, it is mandatory, isn't it? So in terms of being able to transfer between pension schemes within the UK, if you are on the dashboard, then you are going to be signed up to that, and then hopefully that reduces the risk of scam transfers, etc.
Yes, yeah. So I think, like, by virtue of the fact that you are receiving information on the dashboard from that provider, that makes them a credible provider. So if you wanted to transfer them between any of the 5 or 6 different providers that you may have, you've already sort of ticked the first box in answering that question, that yes, they are a credible provider, because they have had to connect to the pensions dashboard.
Fantastic. Okay. Well, thank you all for your inputs. Really interesting discussion, and great to see so many developments coming through in the pension industry. So thank you for your time, and also thank you for watching. If you'd like to get in contact with us to discuss this topic or any other topics in relation to wealth or how Simplify can help your business, then please go to our website, which is simplifyconsulting.co.uk. You can also see other episodes of the podcast and lots more content on our website. We'll be back with another podcast next month. So thank you all. Speak to you soon. Bye.